NER is releasing its pending home sales figures today, and this is for the month of October, and for the fifth month in a row, they're down.
It's certainly not a good news to see any economic data decline for fifth straight months, but we have to put it in proper context. During the financial market crisis, home sales has slumped, and it hit only 4 million and change, 4.1, 4.2 million. And 3 years afterwards, it remained at that level. Then in 2012, last year, we finally saw some recovery of 4.6 million. Now, even with recent declines, we still anticipate the home sales to be in the 5 million range, and therefore it's still a very respectable, healthy recovery. So one can view the recent decline as much of the heated activity not beginning to come off, but still at a very respectable, healthy pace.
Well, let's talk about interest rates for a second. Now, the current chairman of the Federal Reserve, Ben Bernanke, has said that he wants to keep the policy accommodative, and the incoming Federal Reserve Chairman, Yellen, she has said the same thing now. But you have said in the past that you believe that rates should start moving up, and do you still feel that?
Ben Bernanke last week in his speech made it clear that the Federal Reserve will be very accommodated as needed, and furthermore, the incoming chairperson, Janet Yellen, has also said the similar. And what that means is that as long as the unemployment rate remains above 6.5%, it will be an ultra-loose monetary policy. Fed funds rate will be essentially at zero, and there will be still some degree of quantitative easing. But the mortgage rates and also longer-term interest rates are not directly controlled by the Federal Reserve. It's also impacted by other factors, principally potential inflationary pressure. Fortunately, this year we had no inflation. But going into next year, we may begin to see higher inflation, and in fact, we may actually cross the red line that the central bank considered to be somewhat high inflation, that 3% inflation mark. Why? Because the core component of housing, the apartment rents are already rising at 3% rate. The owner equivalency rent, what the homeowners would pay in rent if they were renting out their home, that's also rising and accelerating. So if we get some reversal in energy prices, we could easily cross the 3% red line inflation figure next year. And if that's the case, long-term interest rates will be rising independent of the Federal Reserve policy. And therefore, I believe that the mortgage rates for most of 2014 will be in the 5%, 5.3% range.
Well, let's say the rates do rise. Now, are there some offsetting factors to that?
Fortunately, the reason why interest rate would be rising or the inflation would be rising is more active economic activity. So economy is growing, jobs are being created. From the low point of several years ago, 7 million net new jobs. Each year it looks like we will be adding another 2 million jobs. Albeit this is more sluggish recovery compared to more normal, but still it is a job addition, and more jobs mean more potential home buyers. So that would be one compensating factor. The other potential huge compensating factor is that the banking financial sector are flush with cash. They have been raking in profit from much increase in refinance activity over the past few years. But with rising rates, refinance will collapse next year, possibly to a 15-year low levels. So the lenders will be looking for new profit opportunity, and if they examine their book, they will recognize that the loans for home purchase in the past few years have been performing outstandingly with very little default. So the banking system could open up more lending for home purchase, so that is a huge potential opening for home buyers to enter the market in 2014.